point of today's topic is to really address a lot of what we've seen in the marketplace in terms of the volatility and the issues, and there's a lot of concerns out there because of it, and rightfully so. And I want to kind of address a few things and what I've learned along the way as an issuer, as someone raising capital, as someone who's built a fund, what I think maybe some people are not noticing. So what I wanted to do with this topic was essentially, I've built a guide as well to go with this. So I think in the kind of active investing world that we're all familiar with, we know very well how to due diligence on a property. We know, how to run our numbers. We know what questions to ask. We know we want an inspection. We know we want all these things. But what do you do when you're analyzing a passive opportunity? And I think that's really the point of this. Okay, can you see my screen? Yes. Thanks so much, Ken. Okay, now it's working for me. Of course, now Google decided to work. So that's kind of where this came from. I, like many of you, over the course of the last year, have had lots of challenging conversations with a lot of people who have been put in some very difficult situations. And I feel for them. And what we can do as a community, ideally, is learn better from this. What could we do to know how to protect ourselves, to know what questions to ask, and if you're raising money, also what you need to know, because these are all very important things. So before we dive into that, I always have to put up our disclaimer. Anything that we are discussing tonight is for informational and educational purposes only. We do have this disclaimer available on our website if you want to read through it. It's there for you. And this is not a solicitation to invest. It is merely for informational purposes only this evening. So before we jump into it, my name is Natasha Phipps. I am the CEO of WealthShare. I am joined this evening as well by my two other co-founders and partners, Rodney Phipps and Monique Verlan, are here this evening as well. And we have had a lot of internal conversations about this topic, and also have learned a lot just building WealthShare. So hopefully we can provide some value here this evening as we dive into this topic. So let's get started. Understanding the passive investing phrase or term, or what the heck does that mean? Because I think that gets used a lot, but it means a lot of different things. It's not just one single thing, but usually the term passive is what's attractive originally. Many folks may be interested in passive because they don't want to get the debt on their own, or they can't qualify, or they just don't want to manage any properties. They don't want any work. They want to stay as hands-off as possible, which is very attractive for a lot of reasons. But there's some key concepts that I think we need to be separating when we're talking about passive investing, and they tend to get thrown into one lump. Private securities, where you are often investing into some type of fund or group or GPLP, there is often a equity component with that. Whereas private lending, which can encompass a lot of different things in terms of, that could mean a private mortgage, it could mean a promissory note. Peer-to-peer type of lending is a very different thing, where there is potentially no security or some security that could be registered against a property. So these are two very different things and concepts in the passive sort of investing space that I want us to be talking about in greater detail. Now, something that is not often considered, no matter which of these paths that you're going, there is legislation in this country that defines who should be investing in what, defines the oversight and regulatory restrictions that should be in place for the type of capital raising that an issuer is doing. And that is information that's glossed over a lot. So I'm going to dive into that a little bit deeper. But we at WealthShare, we're a private security, we're a private REIT. And the benefit of that to our investors are the significant regulatory requirements that we have to meet to be a classified fund here in Canada. And that's very different than, say, me and another individual decide to loan money peer-to-peer. That could be a a private loan. It could be a promissory note. And there's no real oversight with that. There's no one checking on that. It's very much, a promise to one another if it's a promissory note that has no security, or you can drop an actual mortgage as well, which is done, or a actual loan that has some type of security with it. But the level of scrutiny that a fund would go under is significantly higher. Also, in private securities, such as WealthShare, because we are a real estate fund, because we have an offering memorandum, we also have to do a independent audit. And so I always find it interesting too, even in like joint ventures, as you're moving through a joint venture, you're kind of, a year or two in, you're kind of taking a guess is where you're at, but there's not a third party independent audit being done because that wouldn't make sense at that small size of a deal. So if you want that type of oversight and that type of regulation to be overseeing your investment, you need to go into this private securities type of space, because you're not going to have that in a private lending situation or a peer-to-peer situation. And next slide. What real estate's largest edge? So we've just talked about a few different ways you can passively invest. So you're going to give up control because you want to, invest passively. Great. You want your money working for you while you're doing other things. Awesome. What is interesting about what has happened in the last year and how huge these promissory note groups got is actually it was just actually surprising at how large and all-encompassing it was, and how quickly so many people gave up real estate's largest edge, which is the security. It's the asset. It's the physical thing that you can see, feel, and touch. And with a promissory note, you don't have that. It's really just a promise that I'm going to pay you back, or vice versa, and we have an agreed upon amount and whatever else we've agreed upon, but there is no security. And the security is one thing. And then the second layer of that is real estate's most predictable return on investment is pay down of debt, right? And so you're letting two of the kind of like safest, most predictable things about real estate go. Rodney kind of jokes that, you may as well go look at crypto kind of thing. Like you're losing your security and you're losing your hard asset. And so why would we do that? And people are doing that because this word here is being forgotten. Suitability. So why are so many investors giving this up? Sexy returns, sexy numbers. You see sexy numbers and they are attractive. Do not get me wrong. We all want more for less. That's just the nature of humans, right? We want the most we can get for ourselves naturally, totally understandable. But why is the term suitability not like at the tip of our tongues when we're talking about passive investing? It really, really should be. So what does that mean? What does suitability mean? So many people are familiar with the terms eligible and accredited investors. And let's talk about what that means. So eligible versus accredited is a definition put out by our country, and it's different in each country what it might mean, and determines honestly how much money you can lose. It honestly determines your suitability of an investment based on your net worth, your financial assets, or your income. It's determining your ability to recover in case of a loss. And so when we ignore what is suitable or what these suitability definitions are, it is putting the investor at risk. It is also putting the person raising the capital. It just tells me that they haven't spent enough time on this, because this is really, really important stuff. And so the suitability, and that's why it's so important. But what a lot of these people often, not all of them, many of them were accredited investors, but a lot of them were not. And the non-accredited or eligible investors were wanting the returns that should be, according to this definition in Canada, those type of investments should have been reserved for accredited investors if we're all following the letter of the legislation here in our country. And so if we are not following that, or we don't understand it or know about it, or it's not being talked about, we're creating a big problem. And that, in my opinion, is how we've gotten here. And these kind of higher risk promissory note opportunities often come with a higher return, which they should. They're higher risk. You should be getting a higher return. But they also come with that substantially higher risk that we have to be aware of. And we're seeing, sort of the bad news because of that. But there's no security. There is very little oversight because the documentation is very simple. That is something people like about it, actually. It's very simple to understand. It's a 1 or 2 page document, very quick to sort of review. But this is not being considered. And that's the scary thing. The other thing to consider about this suitability thing, and what I've heard a lot of folks say too, in talking to hundreds of investors about this, is they're also attracted to the monthly returns. Like, we've been asked that here at WealthShare, why do we not do monthly distributions? Several reasons. For us, every time we do a distribution, there's a massive regulatory process we have to follow, and big costs, and we have to do an audit, and it's very expensive. So it doesn't make sense. But even without all of that, if you are doing a project or you are managing anything, if you are promising high interest returns every single month, very easily, we all know how unpredictable real estate can be. Things can come up, and very easily you can get yourself off track. So it allows very little time for any sort of project to recover if there was some sort of speed bump. And honestly, it puts the project at risk. And the people often I find who are interested in this really are using debt to invest, which is fine. There's all kind of reasons why you would want to use your line of credit to invest from a tax standpoint even. But if you cannot carry your investment, I may ruffle some feathers with this, but if you realistically cannot carry that investment without that monthly payment, then maybe we should be considering whether it's suitable, because something might go wrong. There might be a delay. There might be things that come up. And so that is really what we need to be aware of when we're talking about suitability. All of these things are so important. And the person raising the capital really should be asking these types of questions, whether this is a suitable investment, do you understand the risks, all of that kind of thing. But I don't know, those conversations were had, I weren't there, but from the investors I've spoke to, often this was not something that they understood at that point. So to summarize, accredited investors, they can afford to lose a lot more. They have a lot more net worth and income to protect them. Eligible investors who might not have quite that should be looking for investments that are suitable for eligible investors, if that makes sense. And honestly, this is a big thing too, as to when we were starting WealthShare, as to why we went the route that we did. We could have just set up a very simple structure. We're reserved only for accredited investors and not gone with an offering memorandum. But we wanted to be accessible. We wanted to open the door to as many people as possible, and we wanted to do it right. We didn't want to ignore these definitions. We want to double down on this to be ideally someone who is educating in this space and talking about this. So the structure we built was to be as accessible as possible, open to as many people as possible, to keep our minimum low at $5,000, and just do boring buy and hold real estate as best we can. So that's really what drove WealthShare to get started. And when we came to market, we actually got a lot of flack that at certain times that we were not making the best decisions in that way, in terms of like keeping our minimum low. Like, why would we want to do that? And that was coming from groups who had very high minimums, and we were trying to be the opposite of that. So we want to be accessible, and we want people investing in hard assets that are cash flowing and making money. So how do we keep our edge in all of these things? So we've now learned that the assets, the real estate, in some fashion should be your edge. Whether you're investing passively or actively, you need security in some kind. Now, there's a few different ways to have this. So private lending, which we're all familiar with. You could do private mortgages where you're registering a debt on an asset. It doesn't even necessarily need to be the asset maybe that the funds are going to be used to, but you need to have some sort of security. Now, the problem with this sometimes you run into is if you're not in first position on that property, then obviously the bank or whoever's ahead of you is going to come first. But if there is an opportunity there where you can be registered on title on an asset, you absolutely should be. Whereas if you're doing a promissory note, some people will do a general security agreement on that individual's name. That's another way, but it's not nearly as good as equity on the asset. So those are the two kind of ways: private mortgages, and then the peer-to-peer lending. You just have to know that it's an IOU. That's really what it is. Number two, I find this so interesting: joint ventures. Before promissory notes and using other people's money and capital raising were a thing, that was never a topic. It was all we talked about was joint ventures for a long period of time. We're starting to show, also that these things come and go, trends come and go, what's interesting and attractive. And joint ventures were where it's at. And we still have joint ventures in place today that we've put in, 6-7 years ago that are operating awesome, and we love them. And the great thing about them is at the very beginning, everybody knows what they have in terms of their security. They know that they have their 50% or whatever it is. It could not be 50, it could be 60 or 40 or whatever. But you know what your piece of the pie is and what your roles and responsibilities are. If you're doing a joint venture, please do a joint venture agreement that lays all of these things out in terms of what everyone's roles and responsibilities are, and also what their terms are. Like, is there an end date? How are we going to exit this? So joint ventures do provide security in that way. Often there's a working partner and a financial partner. So kind of similar to the private lending space, where there's a financial component if someone's lending the money to you for a set return, and then someone putting that money to work. So it's very similar to that, but your partners in the actual property. So before promissory notes in this private lending space, at least in my world, it was all about joint ventures. The third one is private securities, and there's a wide range of what's out there. So I kind of want to talk about a few things that I would sort of highlight here. So most people are familiar with GPLPs, or limited partnerships. So if you are investing in a limited partnership, or it could be a corporate structure, you are buying a form of a private security or investing in a private security. And so depending on that, usually you are getting a share of the company or a unit or however many units in the limited partnership that has control of the assets. So the good news there is, from a passive perspective, your risk is generally, especially in limited partnerships, limited to the amount you invest. And you are then working with whoever's in charge of the project, the general partner, to in just a financial capacity that's limited to your investment into whatever they're doing with that money. But so your security is that you have a piece of the pie, ideally, that has the assets. But what's interesting here, I've even had conversations with people and knowing what questions to ask, where the limited partnership that they have the investments in, or the shares of a company that they have that have an investment, is not necessarily the company that owns the assets. So this is a really important question to ask: is who is the beneficial owner? Even when you have security, who is the beneficial owner? Who owns this property? If something was to go sideways, or things have to be sold, or whatever it is, who owns the property at the end of the day? Because I was shocked to find out people really thought so-and-so was the owner, but they weren't. Here in Alberta, you can pull title on any property for $10. Anyone can. You go to spin to the government of Alberta and you can pull title. So you can verify these types of things if you're not sure who owns this property, who's the beneficial owner. So that's really, really important, is how are you getting your security? Now, in the private security space, like looking at WealthShare just as an example, as a private fund, a lot of people think that Monique, Rodney, and I own the assets. We do not own the assets. Our almost 300 investors own the assets. We're the managers of the fund, or the managers of of these assets. We have personally guaranteed this debt. So we have a lot on the line, but we're actually not the beneficial owner. The investors are the beneficial owner. So that's very different than, doing a private lend on something where a different entity owns that piece of real estate and you don't really know, right? So knowing those types of questions to ask are really, really important at the end of the day. Okay, so I mentioned this at the very beginning, was about, we all know how to analyze active investments. And so how do we manage passive? So I actually did do a guide. I'm actually going to pull it up here, but we're just putting on the finishing touches of just like a few pages of what questions would I ask? What have I learned going through this process now that I know that I probably wouldn't have known 5 years ago in looking at these types of offerings like WealthShare and all the other ones out there? How do you compare certain things? So the first thing, we just talked a lot about it, is security. Before that, also kind of in between these two, is knowing your investor profile. So we talked about suitability, so that's really important, but also from suitability, there's also things like, what is your risk tolerance? What is your ideal timeline that you want to invest? With WealthShare, we're a long-term investment. We are not, here just for 12 months. We are putting our money to work and buy and hold real estate, and that requires time in the market. So we recommend, a minimum 3 years, but ideally 5+ years with us. There's all types of different timelines out there that folks could align with their investment strategy. So knowing that, knowing your financial objectives is important, but then aligning that with your risk tolerance, because we all want more. I mean, more is more, but what am I comfortable with? And that's a few really important things. Analyzing your knowledge and experience. If you really don't have a lot of knowledge and experience, on the active side, like buying a piece of real estate, people will go and find often their investment specialized team. They'll find their investment specialized mortgage broker and realtor and an accountant. But I find they're often afraid to spend any money or time, for example, getting a legal review done. This is always surprising to me. We encourage you to go get our documents reviewed. And anyone who is, serious about this should be encouraging that, because it is critical that everyone understands what this investment entails. So I always find that one interesting, because we're so okay to do it on the active side with, inspections and assessments and all kinds of different things. But on the passive side, it's much less common. So we also talked about understanding the kind of different types of investment. That's another thing. So moving to the team, what would we talk about with the team? So who is the team, number one? What is their experience? But also one little tidbit I just mentioned there, which a lot of people don't know, is the beneficial owner. Like I talked about, who is that? Who is guaranteeing the debt? Because if it's multifamily or commercial, anything larger, and they're using a lender really of anything of this size, someone needs to personally guarantee that. So asking those questions, will they be forthcoming with that information? Do they have skin in the game? Do they have, a reason to really do everything they can to make this happen? So who is the team? What is kind of driving them? And does it align with you? And do you have that good gut check feeling? So third is structure. What type of structure are they using? And there's certain things that will have more and more benefits. Obviously, the more complex a structure can be, the more often there's more checks and balances that will protect you as the investor. So like I mentioned, for WealthShare and other funds like us, we have to do an annual audit. So the benefit of that is, as time goes on, annually, our investors get to review our audit returns every year, but also our return that we announce is a result of that audit. It's not my opinion or Monique's opinion or Rodney's opinion. It's a audited return. Whereas if we were just doing a partnership, we could say, okay, we roughly think the property is worth this every year, and this is kind of where we're at. You're often not doing an appraisal every year. You're often not going to that level of detail. So how does that relate to what you're looking for? And then also, one thing that's sort of exit plan timeline, but also diversification is a big thing. Whenever there's any volatility in the passive market or the active market or any markets period, it's very quickly apparent who is diversified in some sort of capacity. So a very good example of this is in Calgary right now, there's many folks who have actually sold their properties in the last year here, even though they're doing well, to kind of offset some losses somewhere else. Like they don't really want to sell them, but it's protecting some losses somewhere else, or they actually physically can't sell a property because they have troubling tenants in it in Ontario, and they need, capital reserves to help offset some of these challenges they're having. So being diversified in every capacity is really, really important. This is no different on the passive side. So, don't put all of your passive investments into, 5 different types of developments that are same timeline, same geographic area, and are all a similar sort of investment structure. Why not have a sliver of different types of opportunities in different geographic areas with different strategies? Any questions about any of that? Did I miss any comments so far? No. Okay. I'm going to pull up as well. Sorry, 1 second here. So questions to ask. What questions would I ask, and what questions do I think? Because I think this is maybe the most important one, is you don't know what you don't know. You don't know what to ask if you haven't been, down a certain road, or you don't know how the structures work. So questions to ask. The most common one, which people are going to start with, is what is my return going to be? And that's important, but how is that return getting calculated? So you have to have kind of a step 2 to that question. How is that return going to be made? Whether it's a development or a buy and hold or whatever, asking that question, digging a bit further, because often people will just go, what's the return? And then they don't ask anything more. And also a return is then further broken down into equity growth or cash distributions, depending on the structure. If it's a promissory note, for example, then it's all cash distributions and no equity. Whereas with WealthShare, equity growth is a major part of our strategy. So no right or wrong there, but know what you're investing in, especially when you're looking to diversify and make sure that you have different types of investments. Generally speaking, the higher the risk, the higher the reward, right? So again, thinking about diversification, maybe have some higher risk things and some slow, boring things, have a bit of both. And keep that in mind. We're talking about equity versus cash flow. What is the risk level associated with this investment? Consider the strategy. I always find this one an interesting example. We get compared a lot to development opportunities. That's why I'm bringing it up, because people do mention it to me. We're a very different risk profile than a development. We are buying real estate that exists and it's standing and it's making rental income from day one. We can see, feel, and touch it. We know it has permits. We know the city has approved it. We know when it's going to be complete. And that's very different than where, though more lucrative, buying a piece of land, rezoning it, developing it, building it, stabilizing it. There's a lot of variables. So generally, the more variables the strategy has, not one is right or wrong. It's just that's going to determine the risk of the strategy. So that's important to know. Also consider if there is monthly distributions, where are those coming from? If there is no rental income, if there is no money coming in, how are they paying out certain fees every month or every quarter or whatever? And ask where that money is coming from. It could be from, capital reserves. It could be the management team has put an X amount of money, or it could be they're raising more money to pay the investment money that's going out, which is where we run into problems, where you're kind of rinsing and repeating capital. So ask that question. And if they don't want to answer it, then, I think that tells you a lot. So also, if you guys want this guide, I'm going to be sending it out this week. But okay, number 3, what are the fees involved, if any? So if you go to a more formalized structure like WealthShare, There is no fees for someone to invest with us, other than if there's a trust company involved. The trust company will charge you a fee to invest. But where I'm going with this is, I'm always surprised how rarely someone asks me how I get paid or how we get paid as a management team. We're not the beneficial owner like we discovered. So how do we get paid? And those are when it comes to management fees. So if you're comparing WealthShare to other funds or groups, that's a good thing to look at. How is the managers getting paid? Is it a fair amount? Does it seem reasonable? How does it compare to others? And compare those things. So management fees, the term fee can be a little bit misleading. It's an operational cost for us. It's already taken into account when we project our return on investment. So it's not coming off your projected ROI. It's already in there, just like property management and accounting fees and every other fee is to pay ourselves a fee to manage the fund. The third one is dealer fees. So we talked earlier about eligible and accredited investors. As soon as an issuer is raising money from eligible investors, they're using an offering memorandum, or they're using a friends and family exception, which is a very different thing. But if they're marketing to eligible investors like we are, they're using an offering memorandum. And if you're using an offering memorandum, then you have to have an exempt market dealer, or EMD. And this is a place where people tend to get lost, because it's like, well, why do I need another company, or who is this company and why do we need them? But they're there for a very good reason. And I don't think they're given enough credit in this space. The exempt market dealer is there to ensure two really important things. One is that we are actually compliant with all the things that we say we are, that we are doing our filings properly, that we are working with the appropriate trust companies. But more importantly for you as the investor, they're there to have that discussion with you around suitability. They're there as a safeguard to go, okay, does this make sense for you? What does your other investments look like? Do you already have, 100% of your funds in something similar to this? They're there to have those conversations with you and determine your eligibility as an eligible or accredited investor. So that's why the EMD is there. They're mandatory for us because we have an offering memorandum. Though it kind of sucks to have to hand people off to another company, it's there for a very good reason. So they cannot do the investment directly with me or the team unless we at some point have an internal exempt market dealer, which we do not yet. So that's a really important one. Okay, moving on here. Keep losing my spot here. Okay, so that's kind of all the fees that we in these kind of private passive. Now, if you're doing a private mortgage on the more private lending side, or you're doing legal review, those will be other fees or expenses, of course. If you are doing that, that's money very well spent, very, very well spent. Use a lawyer, get them to take a look at it, make sure it's drawn up properly with security. We already talked about asking who the beneficial owner is, how your investment is secured. That's an important one. Number 6 is, what is the track record or the experience of the management company or team? And it can go even a step further, like who's managing the assets, or if it's a development, who's the actual person, who's the contractor, who's doing this project, and dig into who's going to be really critical players of that particular investment. For us, we kind of came together as a group of people already investing in real estate. I have been a licensed realtor and property manager for 16 years in Calgary, have been investing in this space for over 20 years now. Wow, that is a crazy number to say out loud. But that is the reality. And so that experience pays off huge. And the insights I have into the market here in Alberta has already paid off with all of the acquisitions that WealthShare has made. So the experience of the team is critical. The success of the management team and who they're hiring to be on. So our first hire was in-house property management. It was by far the best money we could have spent at that time. Okay, number 6, what are the exit strategies and how do you exit? This is a really important one too, that you have to consider for yourself. And there is no right or wrong answer, what works for you, but just knowing, okay, things change in life. Can I get out, or am I stuck, or what's the process? What are the steps? What can I do? So ask those questions. When can I exit, and what is the process? With us, there is a redemption process in place that's outlined in your subscription agreement. So you can go reference that anytime. But that's a very different thing if there is no plan and it's a very kind of loosey-goosey agreement. Number 7, how frequently will I receive updates on the investment? And also, how can I communicate? The biggest thing I have heard is lack of communication in the last year from people raising capital, or they can't reach them. It's one thing to maybe not be consistently sending out an email every month or something, but it's a whole nother thing when someone cannot reach you when they have questions. So I think we can continue to always get better with our communication at WealthShare. But what we do pride ourselves on is if you need to reach us, we are here. If you have a question, we are here. And I hope all of you know that. Probably everyone has my cell phone number here, and we'll continue to do that. If we don't know the answer right away, we'll get back to you. But making sure you know that someone will pick up the phone or talk to you if you have a question or point you in the right direction. There's certain things we can't help you with, but we can point you in the general direction of where you need to go. Perhaps it's to Atlas One or to Olympia Trust or whatever it might be. So having that team there to support you is critical. And this is a place I have gotten very good feedback on that, there's certain things like I'm not quite clear on this, and we help them out right away. So that's something that we're always striving to do better at as well. And risk mitigation. This is another great question that people are afraid to ask and people are afraid to answer. So how do you mitigate risk? Like, how are you going to be planning for rainy days? And this is an important one. So, and it does tie back to a lot of the things that we've talked about here. Worst case scenario, people always go, what's the absolute worst case scenario? Well, absolute worst case scenario, likely when we're talking about real estate, is you're going to sell the real estate. So what does that mean though? What does that mean for you as an investor? Risk mitigation ties back to how much debt is in the portfolio that you're investing in versus how much equity is there. What is the portfolio worth versus what debt they have? And I think this question is something that was very well not asked to a lot of these groups in the last couple of years that were raising capital far beyond what their portfolio was worth. I just don't think you think to when you're thinking of kind of just a peer-to-peer lend. So that's a very good question, be the first thing I would be asking, and I don't really ever hear it. If they are doing, excuse me, they are doing what we're doing, like buy and hold real estate, it's still a good question. Like, are we leveraging our portfolio to 95%? No, we're not doing that. But most people know about the CMHC insured MLS program, and developers in the new construction space, these are options where you can leverage up that high. I think our debt to valuation, I don't know if Monique is listening, but is not even 80%, or is it around there, Monique? If you're listening. Let's see if she answers. Probably caught her eating. So it's around there, plus or minus 1%. So that's very different. If something does go wrong, things adjust, prices go down. We've got a long way to sort of cushion if there was a correction or an adjustment in the market. So really, really important question to ask. And what I found was Monique says she can't unmute herself. What I found was so shocking reading through these bankruptcy and court filings was how high the debt was compared to the assets that they had. So that was something that I was just really blown away by. Like, I don't know how they were going to possibly make that work. I don't know, Monique, I just hit ask to unmute, but it's not doing anything. So it seems like it doesn't like you tonight.
Thank you. Yes. Now I can talk. Thank you. I couldn't do it on here. Just didn't want to unmute myself here.
Weird.
Apologies. Technological issues tonight.
That's all right.
Sorry, can you just ask that question again?
I was referring to the biggest lesson I kind of took away that people might not have known to ask is, what is the debt ratio that's in place when they're investing or looking at someone's portfolio? Like, they don't know to ask that question. And I just said, our debt to kind of equity ratio that we have here is right about 80%, or is it even a little lower?
Yeah, it's slightly lower than that.
Yeah.
Yeah.
High
So
seven.
yeah, it's high 70s.
So that's very different, right? Than like these groups, like, oh, we have 20 million in assets and we took in 100 million. And I'm just picking a number. I'm not saying that is an exact number of anybody, but they were significantly higher, multiple times what they had in their portfolio. So that is huge, huge problem when we're talking about risk mitigation. So that's why I wanted to bring that up, because I don't know if 5 years ago, I would have asked that question, knowing what I know now. So that's a good one. I had one more. Where's my questions? Probably the best one for this. No. Yeah, debt to equity. How does the management team get compensated? And then does the management team have skin in the game, or have they personally guaranteed the debt? We already talked about that. So that's a huge one. Like Rodney and I, we have 2 kids. We our entire life is guaranteed into the WealthShare portfolio. So we have a lot on the table to lose. We care a great deal, plus the capital invested to start up WealthShare. So these are important questions to ask. So that was kind of all the questions I had in this little list that I wanted to run through. Unless Monique or Rodney, do you have another or a question you think I should add?
I think you need to unmute Rodney as well, please.
I've got some sort of like rules on tonight or something.
Yeah, I don't blame you for wanting to mute me, but no, I just was going to kind of add, because like you're talking there about the leverage that some of these groups are potentially using, where they have borrowed a dollar amount that maybe matches the asset value, which is wild. So that's like another level to giving away the edge of your real estate. Like the edge is you have the security. So then, first of all, you're giving away the security. But then even if you have the security, you're so leveraged that it almost wouldn't matter. So you're taking this approach to investing in real estate that is sort of counter to the whole reason why I think most people are getting into it. And the one thing that was a common thread through all of these points that you brought up is the asking questions. There's constantly new people to investing in real estate, which is awesome. That's one of our raison d'etres, if you want to say that. And if you are new to investing in real estate, you should be asking questions like all the time. Ask the questions. How hard is it to invest your money? If it's really easy to invest your money, it's potentially really easy to lose your money. And anybody that knows me well knows that I'm all about taking risks. Risks are not terrible, but they have to be calculated, and you have to understand that when you are making that investment, that is the risk that's associated with that investment. I think, unfortunately, in the rush to get a good return or get into the market or get your money working for you, people stop asking those questions. And if anybody that you're trusting with your hard-earned money is unwilling to answer questions or unable to, that should be telling in and of itself, right? That's, I think, one thing that we really hope to do. We really plan on doing, all the team, is ask us the hard questions. There's nothing that any of us like better than getting a question we haven't either answered before or don't have the answer for, because that ensures that we continue to push ourselves and figure out these things, but also that we have the comfort in accepting your money and then putting it to work, right? Like easy come, easy go is a saying for a reason.
Yeah. And, communicating what isn't going right too. There's been plenty of things that have come up since we started that were not, I don't want to use the word mistakes, but like something you can't predict. Like bond rates going on a roller coaster, like CMHC changing policies every 5 minutes in our first 18 months of operations. Like there was massive, massive hills we had to climb right out the gate to continue to be successple. But what we kept doing is we're sharing what are learning and going, we didn't know this, like you should know this. Hopefully if you're going down this road, you know it now that we have shared it. So we want to share what we're learning. And the world is always changing, but sharing what we're learning along the way is a big part of it, because there's things all the time where it's like, well, I wish I would have known that, or I wish I would have known that, or, like I need to share this because so-and-so needs to know this. So we want to be that source of information and resources. And that's why we're doing these webinars. Obviously, yes, we want to grow our community and we want to continue to grow our portfolio and raise capital and all those things, but we want to do that with people who have that aligned vision with us. And hopefully, I think so far we're doing a good job at that with our almost 300 investors, and a significant portion of them are active investors as well, who use us as a resource, who are, you know, really much in the same camp. So sharing what we are learning along the way is a huge thing.
Yeah.
Oh, sorry.
No, I was just going to say, like, we've been bringing this up a little bit, and we'll bring it up more. And it's one that that Sean will introduce at the October 10th event. He always says there's long-term plans with long-term people, and that's what WealthShare is about, right? It's not a get-rich-quick scheme, but it is thinking long-term about your assets and your investments on a long-term pace, and with people that are thinking about it in that way. And so it's really important that when you're assessing these investments, you're assessing these decisions, that aligns with what you want to do, right?
Mm-hmm. Yeah, absolutely. So kind of, I thought as a good last slide would be to review what our offering is, because these are the key components when you're comparing us with another offering that you should be looking at. That I don't know if people know. Just take a quick snapshot look. What should I go find? And the first one is, who is it open to? So who is the investment open to? That should be a very first question that should be very apparent. And if it's not, red flag right away. So who's it open to? Second thing is, what kind of money can I invest into this? Do you want to use cash or registered funds? Because that will also divide who you can potentially invest with. So we take cash or registered funds. And then the minimum investment amount. And so there's everything out there from, you know, like our minimum of 5,000, which I'm pretty sure we started this trend. And there's several that have followed suit, which I'm pretty happy about, to, you know, I had someone try to cold call me on $1 million investment not that long ago, which was pretty funny to think that I have $1 million sitting liquid somewhere. But anyway, so finding that. The fourth thing is the returns. And this is where, especially at conferences and events, there's a lot of things, I've literally had people come up to our booth and go, 12%, that sucks. So-and-so is willing to give me this. And it's like, okay, well, like, let's think about what are the follow-up questions that we've just learned that we should be thinking about when we're talking about this targeted return. Does it align with my strategy? What kind of risk do I want to take? And does it provide the type of strategy I want to invest in, where I want to invest in? And then you can kind of start diving into different ways that you can do that out there in the marketplace. But the reality is, in buy and hold real estate, you're not going to do better than this passively, because there's only so much cash flow coming in on an asset, right? So you're kind of also then looking at who is the group behind it. Like I said, if it's a buy and hold asset, what people love about us is they know their money's going to work in Alberta. They're very concerned about other markets. And so that's a huge benefit. They love kind of what we're bringing to the table in terms of our community and education and everything. But I wanted to talk briefly also about preferred returns. And what does that mean? It can mean different things. There'll be a definition of what that means. But if there's a preferred return, ask about it. What does that mean on that particular offering? For us, what it means is, us as the management group, we do not get to take part in any cash distributions the fund might do unless we hit an 8% preferred return to our investors. So that's a pretty important incentive for us in the long term. Now, we know starting WealthShare is a long-term gain for us. Like the first couple of years, it's not that this is a long-term vision for us and why we are doing this. The small fees that we collect to manage the fund really just help keep the lights on, but this is what's in it for us in the long run. This is what we see in the long run. 4 and 5 are kind of, things to consider, but is it a continuous raise, or are they raising a certain amount and then closing the fund? For us, this is a continuous growth of a portfolio. So we need our investors to continue to invest to grow. If we don't raise another dollar, then our portfolio won't grow. That's just the reality of it. But there's many other things out there where they're raising $5 million. An important thing the reason I wanted to put a little note here though, was often in those, it may take 6, 12 months or however long to raise that kind of money. The closing or your returns are calculated often when the closing occurs or when they've kind of completed that. There might be tranches of an investment, but knowing when do your returns actually start getting calculated is an important one. And often in these close raises, it could be a date that's months in advance, and people don't know to think about that. For us, how we do it is we typically do a closing every single month. So if you were to invest with us, the middle of the month, the first of the following month is when we close, which means we file everything with our exempt market dealer and the Securities Commission in the province you are, and the funds are then transferred to us. So that's something to consider on these raises and to dig into in terms of the actual text as to when does your money actually start working. Because we're on a continuous raise, we have no limited number of trust units there, but in other examples, there might be limited number of X, and then there also might be, several other offerings that you might want to look at. So knowing what the structure is and the amount of units available is something to compare. What I didn't put on that thing too is to also remember to look at how is the management team getting paid. That has to be disclosed on the offering, especially, well, on an exempt market dealer's platform, it is disclosed. And there's a very wide range of how groups are getting reimbursed. Sometimes it could be a split of equity. It could be a flat fee a month. It could be, a portion of returns. It could be all kinds of things. So that's what we need to go look at and go, does that make sense for the type of project that it is and who is running it and all that kind of things. And if it doesn't, maybe ask some follow-up questions. Is this helpful? Is this good information? Curious what you guys think. Ken, what do you think? Good? Good info? Can no one else unmute, or is it just my WealthShare team? That's you can't. Okay, good info. Okay, good. I just asked you. That's so weird. Awesome. That's great, Nicole. That's really important for sure. As a new investor, we want everyone to know what questions to ask. And anyone who makes you feel not comfortable asking questions is giant red flag. But I'm sorry. And what we decided to do internally is to address this head on. There's a lot of people that are scared to talk about this. They're scared to share what they know. And we want to be the opposite of that. So as a follow-up to this, I think we're putting the final touches on this guide. I wrote it out, but yeah, say the host cannot mute themselves. I don't even know how to do that. But I hope it gives you a bit more confidence as to what you can ask, what you should ask, what we're more than comfortable people asking us. And good, that's great. That's exactly what we want. Right. Good questions. So, to kind of wrap all that up as well, if you do want to meet with me, here's a link to my calendar. And we're talking about WealthShare here this evening, obviously, but we're here to support you with what you need in the real estate space. If you ever need referrals or recommendations or whatever, we're here to share. But at the end of the day too, if WealthShare might be of interest to you, we'd love to have you if you're not already invested with us. We have a couple things we would love to take a look at this winter in terms of acquisitions. The great thing, guys, about my career is I get to find out about things well in advance. So there's things that are about 6 months away, that are 18 months away. I had a great call today with a large developer that has opportunities that no one else has. And that's really what we can bring to the table here. And we have incredible management in-house. That is the most important thing. I didn't even actually add that. This is another great question, is who is managing the assets if it's a long-term buy and hold? Because the value is really driven by how well it's managed. So that's another question to ask. But we would love to have you invested with us. Like I said, it's a minimum $5,000 or more. We are I'm also doing a promotion coming up for Summit this weekend. If you are investing with registered funds and $25,000 or more, we are going to set up your trust account fees for the year for you if you would like to do that. But if you're at the Summit this weekend, come say hello to us as well. If there's any questions, please feel free to type them in the chat, or I can unmute you as well. Oh, Ken, good question. We can review that again. Ken asks, what do you mean by 8% preferred? So our definition might not be what others are, but what ours is if we do not reach an 8% return to our investors, then us as the management team do not take part in any sort of performance bonus for that year. So in the long run, if what's in it for us, like, you know, say we have a 12% return and 8% of that is equity growth and 4% is cash distributions, we, the management team, will get a 20% performance bonus of the cash portion. So in the long run, as this grows, that's really what's in it for us to kind of get the portfolio to that point. So that's what that means. Now, elsewhere, that might mean a very different thing, but that's what it means here. 15 million. So we're about a third of the way, a little more than that. I would say we, the first building that we acquired, we didn't have all this entire structure set up yet. We didn't have the EMD. We didn't have any of that. And we've used a couple different ways to go, but yeah, we're about a third of the way there. But really, it's not like we're going to hit 15 million and then we're done. Our initial sights were set on, let's build a $100 million portfolio and then take a breather. That's what our goal has been. There's a certain amount of things that start to make sense from an expense standpoint, a number of doors standpoint, with staff and costs and all of that. And that's what we're focused on getting to. And so that's why we came up with this like $15 million target. But as we said earlier, it's not like we don't have to hit it or else everything's going to blow up. We don't have to. And we also can go well past it and continue to grow. So it really depends on the support of our investors, which we need, and we want you guys involved. So yeah, that's kind of what we have to offer. Yeah, any other questions? I mentioned the October 10th event. There was one other thing I was going to mention. What did I miss? Oh, the referral program. That was the other thing, guys. If you know someone that might be interested in real estate, I find our real estate investors are also sort of like leaders in the space. The fact that you're here spending an evening learning about this shows that you're someone who likely is a little more ahead of the game than possibly a lot of your friends or family or peers. So if you think this could be a good opportunity for someone, we do have a referral program as well. You can sign up as a referral agent. It's very simple. You're not selling WealthShare at all. You're just going to refer them and say, hey, you should, you know, check this out kind of thing. And we do pay a 1.5% referral bonus for that. So if that's of interest or that ever comes up, let me know. We're always looking for a win-win, and really anyone willing to help share our message here at WealthShare and help to build our community, we want to do that with you. So if that's ever of interest or arises, please let us know. Okay, well, we will leave it there if no one has anything else. QR code there, but you can also reach us at our website or info@wealthshare.ca, and one of the team will get back to you and we can set up a time to talk. But thanks, everybody. We will leave it there. Okay. Thanks, everybody. Hope you have a great evening.